So we have Matt is an advisor at Capita. He helps a lot of you, and he knows how. He's probably one of our most investment technical advisors at Capita. You follow the markets because you really love it.
I enjoy it.
Like you'd rather do that than watch a show at night most of the time.
Like, so my wife gets on Facebook or Instagram. I'm looking at stock charts.
That's all you need to say, I think.
That was it.
Yeah.
I think
sounds about right.
Yeah, sounds about right?
Yeah.
So basically we have, we've got Matt here to help look at it from an advisor's perspective. Kurt will do most of the talking. And what we'd like you to do, if you can, is put your questions in the Q&A. I'll help moderate and watch those. So if you can do the Q&A, that's going to be easier for me than the chat functionality. If you can't figure that out, it doesn't matter. I'm going to watch them both, but preference would be the Q&A, because then I can check off that we've answered them and keep track of them a little bit better. But I'm going to go ahead and stop sharing, Kurt, and let you dive right in. And maybe if you want, you can start with a couple of the main questions that you're seeing, and we can just let it go from there. How does that sound?
Yeah, that sounds great. I'm actually, now that I can see you clearer.
Oh, let's do that again.
I'm marveling at,
Oh, man, just when you coughed.
right when I went to cough.
I'll come back to me. So we've got a camera here, and then we've got a camera there for Matt, and then we've got a camera for the whole room, and we've got our mixer boards. We're getting serious.
Man, look at it. You got the studio. When can I be invited in studio?
You could have been here or here today.
I know.
Been fine.
Next time I'm coming up.
Okay, we'll add a camera.
All right, I don't know where you want to start, Zach. Yeah. The thing is,
I'll just start with like maybe the first and most common question that I'm getting right now is inflation. And maybe we just start there and see where it goes, but you know what's happening more, and you're more aware. So I'll leave it to you, but that definitely is the one. People are really nervous about inflation.
Yeah. You know what? I am going to share. Never mind. I'm just messing around with the screen here. Let me share something here on inflation. So we'll jump around a little bit. How's that, Zach? Is that good?
And the question is really like, most people are scared of rampant inflation. I mean, I think we all
hyperinflation.
Yeah, hyperinflation is what they're worried about. And we need to understand how big of a risk that is, and if there's anything you actually can do about it.
Matt, I am one-upping you in the nerdism of this is a 76 slide PowerPoint presentation that I just constantly have open. It's never closed on my laptop. Whatever. My wife's on Facebook. This is what I'm doing. So I'm with you.
It literally took like 5 minutes for us to get this file to me.
I tried to email it to Matt, and the computer said no.
The computer's like, it's too big.
No. Okay. So on inflation, it's the truth, as with many things in life, is in the middle. The Fed is lying. And then also there is true transitory inflation here. Okay. So at the everyday level of our lives, we're noticing prices go up, but some of this is temporary, caused by two things. You almost always see inflation coming out of a recession. Look at this back in 2008. You don't remember that. Nobody remembers that in 2008 there was a massive spike in inflation. Now, this is used cars you're looking at right here. But I could show you 15 charts of different types of things we buy, that when you come out of a recession, there's an immediate huge jump in price, but it's almost always preceded by that big drop in prices. So in the middle of March of last year, the world was stopping. Everybody was in a panic. The factories get closed. Nobody makes anything. Then you start coming out of the recession, then people scramble to buy everything. I got to buy a house. I got to get out of Manhattan. I got to buy a car. I got to buy a side-by-side, a boat, because I'm not going on vacation. So I'm going to take the boat money. I'm going to, take the vacation money and buy a boat, right? People scramble to buy things coming out. This was from just this week. These are the year-over-year changes in the prices of goods that we buy, and they are ranked by the biggest year-over-year jumps. So you can see several of these items here. These are supply chain issues, number one, or they are the result of 1 year ago, nobody was doing it. Nobody was flying 1 year ago. No one. So of course, you're going to have a big jump in flying, right? The car issue, I think most of us know this now. There's 1 million cars sitting in parking lots that are brand new with stickers in the window, waiting for semiconductor chips. So anybody paying attention knows that if you try and buy a used car right now that's 2 years old, you're probably paying the brand new price or more. But it's simple supply and demand. It's not actually because of inflation. It's inflationary at the moment, but it's actually a supply chain issue. We also have a record 6% of all cargo ships in the entire world are sitting outside of a port waiting to dock. That average is less than 0.5%. So it's 12 times higher than normal. So we're nobody anticipated supply chain issues like this. We are having a hard time getting things to the people that want to buy them. And that's a huge part of what's going on in inflation. So now, on the flip side, the Fed is jawboning us down and acting like there's no inflation. And of course, there's real, genuine inflation right here. We created $3 trillion in new dollars. It's out in the system. We have an economy way better than anybody thought we were going to have coming out of COVID. We had pent-up demand and a boatload of cash sitting on the sidelines. So the truth, Zach, is we're in the middle. There is inflation, and it's nothing like hyperinflation. And in fact, we think we've already seen the peak in inflation. When you want to talk about housing, I'll show you some slides on housing. There are things that have already peaked in our opinion, and they are now going to come back down. One of them is lumber. Lumber is now down on the year. It's down on the year, lumber. 6 weeks ago, we were talking about lumber out of control. And when I early in my career, I was a trader on the New York Stock Exchange. And one of my mentors used to always say to me, the best cure for high prices is high prices, right? Because when the price of something gets high enough, we stop buying it. We just say, I'm done. I'm not buying that. It's too much, right? We're already starting to see that in used cars and trucks, lumber, and some other types of inputs. So now in the next 6 months, we're really going to get to see what's the real inflation picture, and then what really was like supply chain driven and just transitory. The Fed loves this word right now. It just means temporary because we're coming out of a recession. So that's probably more than you wanted, but that's our take on inflation.
Okay, so that's great. And so then we think that it's transitory, or maybe we think that we've seen some of the worst inflation already. Is that what I'm hearing from you?
Yes, absolutely. We think we have seen the vast majority of the big inflationary pops. In fact, if you take it, what happens is we do everything in our industry on percentages. So what's happening right now is 2/3 of the increase in inflation is being driven by two things, houses and cars. But if you take it on a category basis, most categories are actually going back down in price. Just in the past quarter, most categories went down, but we weight it. We weight the basket. So actually, most things are already starting to recede from their price levels. So 1 and 2 quarters from now, we think it's going to look a heck of a lot better than what it feels like right now. And a really important thing is, everyone wants to talk about Bitcoin. The dollar's terrible. We get, the dollar's, my whole career, 30 years, the dollar's dying. For 30 years, people have been saying the dollar's dying. It's ridiculous because every time the world gets scared, they race into US treasuries, right? No matter what you say about what's going on in the United States, it's the best house in a bad neighborhood, no matter what. So we're in a position where hyperinflation is not an issue. You've in fact never had a country go into hyperinflation where simultaneously the currency wasn't being completely abandoned by the rest of the world. You can't compare us to Venezuela, Argentina, Thailand. These are not comparisons that we can make.
Okay, so a couple of questions. We've got someone who I know to be a very fearful of the current political environment, and everybody's in a different side of this, but he knows who he is. So he basically is saying, but what if the Fed injects another 3 to 4 trillion into the economy under an infrastructure bill?
Yeah.
What happens there? Does that create that much more inflation, or no? Or what risk is there?
Yeah, and I'm assuming that's being asked from the question of the standpoint of inflation, right? Like you're creating all these dollars. The dollars are worth less. Okay, let me show you a couple things. So number one, whoever's asking that question is spot on. We're creating a lot of money. You're seeing it out here in the money market funds, all-time highs in terms of the amount of dollars that are parked on the sidelines, right? The savings rate, like when people get scared, the saving rate goes up, right? We don't have World War II, but World War II topped about right here, about 15. We got to 30% savings rate during COVID. I mean, COVID was a scary time. We don't even realize how scared people were. Like, think about this for a second. If you are hoarding toilet paper, you are scared. Like, you didn't see that in the financial crisis. You didn't see that in the dot-com meltdown. It was scary. People were socking every dollar away they could for about an 8-week window right there. But you're still running really high on savings rate. I got some other data on this to show you. But what ends up happening, though, this is the biggie. The velocity of the money is the issue. Where is the money going? This slide I just showed you is where the money going. At the moment, it's not inflationary and it's not cheapening the dollar because the money's being created and then it's sitting in the bank. This is the strangest development, to have the economy good, the stock market good, the housing market good, lots of new money, and no one wants to spend it. Yeah. People are nervous. People think we might be in a bubble, but the truth is that people are actually nervous and stockpiling capital.
And Kurt,
let me show you. Yeah, go ahead, Matt.
Back real quick, just to pause on it, because I feel like we're talking about some economic terms that we may not follow. So go back to the chart with the velocity of money, because I feel like this is a indicative sign. We started this with 70s music, right? Most people actually remember the 70s as being a time where there was a lot of inflation and interest rates went really, really high. If you look at this, you can even see on the chart, I believe it, let's see, yours things on it, Zach. You got to move your Q&A.
I'll get that out of
there.
But
we've got the 70s on there. The velocity of money is basically how quickly is money changing hands. And typically when it's higher, we see inflation. And so that's why when you look at this chart and you're going, what does this mean? What it's trying to get to is, well, in the 70s and 80s, that's why we experienced high inflation. That's why interest rates were really high. We were trying to combat that high inflation. Whereas right now, inflation's really low, still relative to these historical numbers, but it's not changing hands. And Kurt, to your point, it's sitting in banks, and it is driving some of this pent-up demand where people are going, well, I got a bailout and I didn't take my family on a vacation, so I wasn't going to get an F-150 this year, but now I want one.
Yeah.
Right.
Yeah, you're spot on, Matt. And look at that. I mean, we all remember what the euphoria of 1999 looked like, right? And look how high the velocity of money was. It was at an all-time high. Another word I like to use for velocity of money is aggressiveness of money. How cocky are people with their money? They're really moving it through the system and spending it. That's aggressive, high velocity money. Look where we are. I mean, we're in the bizarro world with the amount, with the defensiveness of the money that's been created. So the answer to the question, Zach, you can create another 3 trillion. That's not a problem. But when you push it out and the money starts to get aggressive, that's when you start opening yourself up to bubbles and high speculation and higher inflation and things like that. I do want to show this one chart because it's so stunning. We just found this week from one of the research firms we subscribe to. But so historically, here's all this says. What this says is the more money that Americans are making, okay, disposable income. So the more disposable income people have, the more they spend. This is not rocket science. And notice how the green dots keep moving up. You make more money, you spend more money. Look at the last 4 quarters. What in the world is going on? So when people come to me and they say, oh my gosh, everything's in a bubble and people are too euphoric, this is not true. I mean, asset prices might be too high. The stock market might have a big correction. It might, but it's not representative of the behavior of people with their money. We're actually seeing the opposite of what we normally see when people do well and the economy's booming. We're seeing a real reduction even still, even in Q1, really high disposable income. Wages are really going up, and yet people are not getting back on the spending throttle.
Got it. Okay. So Mike that asked the question that's sitting in there, I think Kurt has pretty much answered that question in general with his opinion on inflation. The only thing in here that I mean, basically with future bailout, we talked about that. With future spending and by the government, we talked about that. I think we're pretty good. I'm gonna move forward on that one. Mike, you know me. You can reach out to me later if you feel like we didn't quite get to that one. Okay, so Kurt, you also wanted to touch on housing a bit because I think it relates to inflation. Should we go? Let's go there next.
Yeah, let's go there because this is one of those things that impacts everybody's life.
This is probably the second most question I feel like I get.
Is it
inflation? And then people, because you hear the Mark Twain quote, right? History doesn't repeat, but it rhymes.
Yeah.
And so we're sitting here going, boy, it's not repeating, but I mean, I sit at home and I'm like, it seems like it's rhyming a bit, right? Homes are appreciating at an alarming rate, at least, especially here in Utah, where we reside. So
Yeah,
I think
100%.
this would be a good one to cover.
Let me just show you some data. People can make up their own mind. I mean, and I'll go through these quickly. I got a few slides here, but since the data's been recorded, we've never seen so little inventory of houses compared to adults in the United States. It's never been this low. We went after the financial crisis, we stopped building houses for 8 or 9 years in this country. And now with a younger generation that finally wants to buy a house and COVID, people want to get out of the cities, you've got a race to buy the little bit of inventory that's out there. This is a massive departure. Zach, I did touch on this on our last call, but I want to say it again. It's really important. The quality of the mortgages are exactly the opposite of going into the financial crisis. It is mostly the highest credit scores still are the people that are getting the mortgages. This is not a subprime. Subprime has barely budged, okay? Look at this. Still more than 70% of every mortgage that's going out the door is at 760 credit score or higher. Exactly the opposite of the years leading up to the financial crisis. In the last 5 years, there's actually only been a 6% increase in mortgage debt. That's stunning. You think of how good the economy's been. We have barely moved the needle in net new mortgages. Many people have paid off their mortgage. They're cash rich on their equity and not tapping the HELOC, right? So you've got housing prices have gone back and people keep talking about 08, but you're not seeing mortgage debt jump hardly at all.
Okay, hold on. So I'm going to pause us here to make sure that people can interpret this chart. Were you thinking the same thing?
I was like, this is really good.
Okay, so a lot of people who might not understand what we're looking at here, which is actually a percentage of income, because really we have this line that you marked, which is that flat line, which was 08. And then the circle over on the right is current. And people might say, well, current isn't lower than 08. Why does it look like that? Of course, look over at the left side. On the y-axis, we're looking at as a percentage of GDP. So Kurt, let's make sure that I'm explaining this okay, because you'd do better probably. But the idea is that a percentage of how much economic activity we have or how much income our country is producing, that is how much of that is in mortgage debt. And therefore, we were a lot higher as a ratio. If you took mortgage debt and income produced in the country, that ratio was a lot higher in 2008. And the ratio is better, which means we're more solvent. Each of us is a little bit more solvent than we were 10 years, 12 years ago.
Perfect. Because you don't care. Look, everything is relative, right? Because my grandma Brown tells me about buying her first house at $5,000. That means nothing to me. She made like $5 a week, or whatever. So like, I mean, it's all relative to your income. You're exactly right. In fact, I'll show you another chart. This one here. So if you buy the median priced home in the United States, we still have not surpassed 08 yet. Now, how can that math work? Because housing prices are clearly higher than 08, but interest rates are so low that your mortgage is costing you nothing compared to what your mortgage cost you 13 years ago. So if you want to buy a median priced home in America, it's actually a little cheaper right now than it was before.
We talked about this in between our last call, Kurt, and this call. I sold my house to my sister, and it was kind of crazy, but we talked about this. I mentioned it last time, but I want to revisit a little bit. I paid $346,000 for my home a little over 10 years ago, lived in it for a decade, and my monthly payment on that house was about the same as the monthly payment that my sister has on it, buying it now because she has a much better interest rate than I had 10 years ago. And she came with a little more equity than me, but not much. But I sold it to her for $646,000. So almost twice the cost. And
Yeah.
she has about the same monthly payment, which, to your point, Kurt, monthly payment is kind of all that people are thinking about. They're not
Right.
necessarily too concerned about the overall price. They're wanting to know, how affordable is it relative to my take home pay?
And I think the point that we're making with all of this, with the housing that's so important, is I find we have a tendency as investors and as people to have recency bias, which is this bias that says, well, what recently occurred, we think will happen again. And the last time we had a big downturn in the market, what was it? What was the catalyst behind it? It was banking and it was housing getting out of control. So I feel like I end up answering this question a lot because we feel like, well, that's what caused it last time and that's what will happen again. I don't anticipate, just if you go back historically over the stock market, normally the scene of the crime that caused the last recession normally isn't the catalyst that causes the next one. Because
Almost
everybody's
never, Matt.
almost never.
Almost
I don't even
never.
know of it happening.
Yeah.
But I will say something else that's of interesting note is the good behavior that's taking place. So we talk about the good behavior of individuals just barely, that they're getting more money, they're getting bailout, and they're putting it in the bank. Well, the banks themselves are also kind of having good behavior. And Kurt, I'm sure you've seen this as well, but when COVID hit last year, like it was JP Morgan and then or Chase, and then also Wells Fargo stopped doing home equity lines of credit. They stopped, they
Right.
allowed anybody that already had one existing, which means if you have a mortgage and you have a $400,000 home and you owe $200,000 on it, they might come in here and say you can borrow 50,000. They basically said, we're not going to do that anymore to anybody, because to the point they were nervous about COVID and they haven't opened that up even to this year. They still aren't opening those up because they're seeing these home prices appreciate and they understand that they don't want to jeopardize getting people into trouble. And Wells Fargo, even, I think there was an article 2 weeks ago in the Wall Street Journal that talked about them stopping personal lines of credit. So they used to do unsecured loans up to a certain amount, and they're not doing those anymore. So part of me like sees this as an investor, and I'm going, man, I feel kind of good about the banks. We had Dodd-Frank come out. They've got higher cash requirements they have to have. And then now when I'm expecting to see better behavior, I actually am, at least from some of them. I mean, Bank of America is still doing those loans, but they've increased the FICO score that you just referenced there. But we're seeing good behavior that we would not anticipate to see, indicative of a head-on collision with a market crash caused by
It's so well said, Matt. So well said. I mean, look, even last week, Wells Fargo yanked its personal lines of credit. You see that? I mean, what?
Yeah.
I mean, like this is the moment. I mean, the banks have never been so flush with cash. Do you know that bank balance sheets have not been this good since the 70s and 80s? I mean, there is no banking accident coming, Matt, to your point, like none. It's, in fact, it's kind of the opposite extreme. And I don't want to get too far down the weeds, but a couple of weeks ago, well, I guess it's been about 8 weeks ago, the Fed opened up what we call the reverse repo window. They basically went out and said to the banks, if you want to give us money overnight, we'll actually pay you a little bit of interest. They were getting like close to $1 trillion a night. And guess what the interest rate was? 0.5% per year. Because the banks are sitting on so much cash, they will take any income off that cash that they can get on this. I mean, look, the next market accident has nothing to do with that. It might be social unrest. It might be inflation. I mean, there's other things that you could see maybe happening. This is not one of them, Matt. I love it. I'm totally with you.
Yeah, love it.
Great. Okay, so as we move on to our next topic, remember, you can throw any questions you have in here. I do think that inflation and housing are probably some of the top two that we get.
Yeah.
Kurt, if you have other questions you'd like to dive into, I feel like I would like at some point today talk a little bit about just in general, like when it comes, you said banking isn't the problem right now.
Yeah.
But I'd like to hear what is the problem. Like there are always good and bad actors in the scene, right? There are always areas you're worried about. And usually at the end, you do here's what we're excited about. Here's what we're worried about. Let's make sure we have time for that.
Good.
We had a question come in about, should we refinance a house purchased pre-COVID? This is a personal question and a cash flow question. So if that could help your retirement cash flow or current cash flow, it may make sense. But of course, you got to think about your age and goals. Oddly enough, this is a risk tolerance question. A lot of people don't realize that, because what you're doing is you're potentially freeing up some cash to be able to invest. And would you rather pay down your debt and get a guaranteed 2 or 3% you don't have to pay, or would you rather move it to an investment portfolio and seek a 7 or an 8% rate of return, not knowing if that's actually going to happen? So there's risk-free and risk-on returns, and we need to be aware of that. But it is a good question. I'm a little hesitant to say anything blanket on this, but I'll give you a couple of examples. If you have mortgage insurance and the value of your home has gone up enough to wipe out any mortgage insurance requirements because you now have a higher equity, that is not necessarily a refinance. Usually you can just go straight to the mortgage lender, have them do a quick appraisal and drop that. So that would be one reason to hurry and dive into that. I had a client ask me this week if they should sell their house. They have 2 homes, and just because prices are so high, they asked me if they should sell the one they're living in and take advantage of the prices. And I had to ask her, I said, well, where do you want to live? That's the real key here. And she said, I want to live in the house we were thinking about selling. I'm like, well, then don't sell the house. Like, there's too late in life, and you're not at the right stage to be doing that stuff.
I even have a good friend that sold his home 2 years ago in anticipation of a housing crash, and moved his family into an apartment.
Yeah.
I mean,
been brutal.
But it's been brutal, and they've missed the run up to where that's like my other favorite quote is, and I'm going to butcher it here. Kurt, you might know it better. Peter Lynch talks about more money has been lost by trying to avoid a market downturn than has ever been going through a single market downturn.
100%. 100%. You know, we manage assets for about 1,500 high net worth families in this country. And the amount of cash that they are sitting on is stunning. Yeah. I mean, upwards of 30% in, treasuries, cash, money markets, and things like that. I mean, I'll give you a scenario. Nobody wants to talk about this. You don't hear anybody say this because none of us are crazy enough to have this come out of our mouths. There is some decent level of probability that asset prices are going a lot higher. And we don't like talking about that
because when you say asset prices, to translate that to our listeners here, we're talking about like stock values and business values. And that's what you mean by asset prices, right?
Yeah. And we don't like talking about it because we're all uncomfortable with this. Stocks are not cheap. Houses are not cheap. But we're in unprecedented territory. We have $6 trillion sitting in bank accounts. That's unheard of. We have most of my clients trying to figure out what to do with cash. We have 0 interest rates. So when I started in this business, you could buy a bond portfolio and get 6% return. High quality bonds for 6%. Are you kidding me? Like, high quality bond portfolio now, you can't keep up with inflation, right? This is a recipe for possibly our economy lifting a whole nother factor. And that inflation actually really does become the problem. I mean, but in the meantime, if you've moved to the sidelines, we have clients selling their house because they're convinced it can't go any higher. That is not how asset prices act at tops. We have people being conservative when really I could paint a scenario for you where you do not want to be out of growth assets for the next 5 years. I mean, I'm not saying that's for sure what I think is going to happen, but I think there's just as much likelihood of asset prices moving appreciably higher. I give you an example. As we sit here right here at this moment, year to date, just take the S&P 500, the biggest 500 publicly traded companies in America. The market's up 16%. Those stocks are up 16%, okay? But their earnings are up 45%. And earnings estimates are up 21%. So both the estimates and the actual earnings are up a lot higher than the stock prices are. So what does that mean? The stock market is actually getting cheaper since January 1st, not more expensive. So you actually have an economy that's doing a lot better than people think with a wall of cash sitting out there. So I'm not saying that's what's going to happen, but don't let yourself get too scared because the price of your house and your stock portfolio happened to go up a lot in 1 year. That's a major mistake that people make, is saying, well, I got to get out. That must be the top, because we've kind of been conditioned for this. And I'm not saying there aren't things to worry about. And that was your question, Zach. There are things to worry about. But at the same time, we can't have irrational fears. And to Matt's awesome enunciation, it's not the last crisis. That's not what you fear,
Let's do it. Give us some, maybe pull up some slides of what you're researching
Okay.
right now, what you're thinking about, maybe good and bad. I mean, I would say, given that we haven't had too many specific questions come through beyond inflation and housing, let's see what's on your mind.
Yeah, let's talk about a couple other things I'm worried about. I just alluded to this. Nothing is cheap. You know, this is what the S&P 500 looks like right now. It's expensive. Now it's getting cheaper. And even since here, it's gotten a little cheaper again. Okay. Then what an awesome thing. What an awesome thing to have your stock portfolio going up and the price and the stocks themselves are actually getting cheaper because the companies are making more money. We could have a whole sidebar about that, right? But it doesn't matter the level of the stock market. It matters the level of the market compared to the amount of earnings of those companies. That's really what matters, right? And that's what this is showing you. But it's not cheap. Let's not kid ourselves. The market's not cheap.
Can I just add something here? Because I hear this. Yeah. This is what I hear from people all the time. They take an absolute nominal number like the S&P 500 or the Dow Jones and say, well, it got to 30,000 or it got to 3,000 for the S&P or got to 4,000 for the S&P. And in our minds, we assume it's like gravity and that it has to come back down. When in reality, as long as those businesses earn a little bit more than they did the previous year, that price doesn't have to ever come down. That's something I don't know if we fully are grasping. And the way that this makes the most sense to me is if you simplify it down to like the smallest business you can think of, like a tiny little restaurant. And if they have profits of $50,000 a year, and then next year they have profits of 75, and the next year they have profits of 100, if you were a third-party buyer, each year you would choose to pay more for that business because you're getting 50,000 in one year, or maybe you wait to buy it. So the next year, to get that 75,000 in profits, you'll have to pay more for the price of that business. And as long as that restaurant keeps increasing profits, it will keep getting more expensive forever. And as long as they don't do something stupid, they crash and profits disappear, it'll be fine. So I think this is why we can talk about stocks going up long term, especially as you diversify enough to get some of the concentration risk out. I mentioned that we are fairly concentrated, but we're not completely concentrated. So you buy good businesses, but you don't just buy one. You buy 20, 30, 40, 50. But the idea here, just keep that in mind. Don't fall in this trap of like, well, it went up, it has to come down. And we had a call a while back, I think it was 2 or 3 ago, Kurt, where you and I were looking at some of the stats. I think it was something like, it was like 75% of the time. I can't remember exactly. The market is within 5% of its all-time high. It was
two-thirds of the time for 60 years.
Yeah, there you go. So it's close. So basically 2/3 of the time, you're going to think things are expensive and they're 5% off the high. Just have to keep realizing that.
And I think
and to this point, oh, go ahead, Matt. Go ahead, Matt.
I'm going to say really quick, two quick points. I'll pause. I'll make the one point. I was going to say on Zach's point too, with these indexes being able to go up more, understand that those change over time. So GE used to be the most heavily weighted in there. They were huge. IBM was huge. Now you've got Microsoft and Amazon. They were nowhere to be found in the Dow Jones and in the NASDAQ. And now they're in there. So understand that's part of capitalism is new companies are going to come. And as they get big enough, they're going to get added to these indexes. And then that's part of what drives that price appreciation that occurs there. I do have a comment on the prior screen that you just had open there, Kurt. I might take you off your point. I apologize. But I think this chart, if you can see it on your screen there, it's an important one to look at because this is part of the case for why it can go higher, but why people are nervous is because once we're above that one standard deviation, that above 20, that signifies really high overvaluation. But Zach just described a story about how his home appreciated a great deal, but interest rates also went down. You find stocks tend to have a similar type of dynamic because there's no alternatives to put your money. So Kurt, you talked about when you started in the business, you could buy a bond and make 6%. Well, right now you can't do that. There's no alternatives. So that means it becomes more expensive. So part of the thought right now is that people are trying to say, well, could the higher evaluation be here for a long-term period, or will it correct to the mean, which is more in that 16, 25-year average? And this, unfortunately, we don't know. If you know that, please call us after this, and we're going to place some wagers. But the reality is we don't know it, and it's the case for why you have a diversified portfolio that gives you exposure to a lot of different areas and doesn't expose you just to one over the top.
Okay, Kurt, we got some questions. You want to tackle them? I'd like to make sure we tackle questions that people get through. Or did you have something else you wanted to cover?
No, I want to show one thing on
Okay,
Matt's point right here. Okay, is the S&P 500 is currently trading at 21 times this year's earnings. Okay, that's rich because the long-term average has been about 16. So it's trading about 32% higher than its long run average. But look at this. A lot of the expensiveness is literally in the top 10 stocks. The other 490 are not nearly as expensive. So you got to remember the stock market is being weighted way up to the top, right? Believe it or not, 23% of the S&P 500 is in the top 5 companies. So those big ones, the Apple, Facebook, Google, Amazon, they're the darlings, but there's actually a lot of stocks that are not super expensive that are in the S&P 500. So just to Matt's point, I wanted to kind of illuminate that.
Perfect. Okay. So let's talk a little bit, because I feel like the two questions from clients are about devaluation and value of the dollar. But Kurt, correct me if I'm wrong. This is still the inflation question, right?
Yeah.
I mean, when people hear that, when you hear that on the news, like the value of the dollar, what you're hearing is them saying the dollar might be worth a little bit less, which is just the inverse way of saying things might cost more, and that's inflation. And we went over that before, but the questions I'm going to ask these two questions, and then you tell me if there's anything else to add to it above what you already talked about with inflation, which is what about devaluation of the dollar? And then what is the consequence of government spending and pumping so much money into the economy? Value of the dollar question. So help us out here. What's this? Is this any different than inflation?
Well, inflation's one part of it. And I part company, Zacc, with a lot of people on this. For 30 years, I mean, when the first year I got in this business, I've been hearing people worry and hand-wring about the dollar for 30 years. Remember, dollars are just a store of medium, and talking about the value of the dollar is just being compared to something else. Okay, so what do you want to compare it to? The yen, the yuan, right? Turkish lira, oil? What do you want to compare it to? It's literally just a store of value. Inflation is way more important because most of us are not flying back and forth and living our life in Vietnam, the UK, and the United States at the same time. How many of us have multiple currencies in our checking account? Almost zero. Like, it's not even, this is almost a complete non-issue. So the value of the dollar to us, the biggest thing actually is in multinational earnings. General Electric, IBM. Dollar's a big deal to those guys because they're doing business in 100 countries, right? So they're trying to, but to you and me, the dollar, within reason, its fluctuations are almost irrelevant, Zacc. What is way more important to us is our own cheapening of the dollar. Not the dollar against the yen, it's the dollar against the dollar. What does the dollar buy you in the economy? And if inflation is going up at 6% a year, that's a problem. If it's going up at 2%, but wages are going up at 5%, who cares? You're net gaining in all of your life, right? So I part company with people a little bit on that dollar discussion. I'm probably not the best person to ask because I don't get overly worried about the dollar.
Well, okay. So the way that you, just to clarify, the way that you say you part company is because you're not overly concerned about the value of the dollar. Okay.
No. And it's just like gold. I don't need to denominate in gold. I'm not spending gold. I'm not using gold. I'm not eating gold. It's all relative to what I can buy. What is my income? What can I buy? That's the dollar. And you got to remember, one of the things that's going on here is the Fed is working very hard to stave off negative rates in the United States. They don't want negative rates here. So what I'm more concerned about the quality of the dollar. And the way you know what the quality of the dollar is what does the world do when it's scared? And it buys treasuries. That's what happens. That to me is much more important than the dollar compared to the yen or some random basket of currencies that I don't personally have anything to do with those baskets of currencies. None.
I think it's important to know, as you talk about the money supply being a lot higher for individuals and then also for big companies, if you just think if you're a large company and you're going to trade another company, so if
Mhm.
If Apple's going to hire Taiwan Semiconductors to build chips or something, they're going to do it in dollars because,
Right.
believe it or not, it's the most stable. And I think as you as an individual, if you think about that, just to your point, Kurt, that you don't have multiple currencies in your bank, it starts to resonate with you a little bit more. That it's like, oh, I can kind of see, because at the end of the day, most of these businesses are saying, well, what's the most stable way we can do this transaction and have a predictable value? That's US dollars.
And by the way, Matt, I don't know about you, but I don't necessarily agree totally with what the Fed's doing. Yeah, I got a bone to pick with some of what's going on here. But that's not the point. There's no probability, Zach, that the dollar is not going to be the world's reserve currency. There is zero probability of this happening.
Like for a period of time, or you're just like, I'll die before that
Zero.
happens.
Well, we're all dead. We're all dead, and my kids are all dead. Think about this for a second. We have a lot of international clients. Our Asian clients will give their right arm to try to get their money out of China and into the United States. And we've all read the information on this. They are in a panic mode to try to get their money out of their own currency and get it into dollars, right? You tell me, what are you going to, if I said to you right now, Zach and Matt, you have to give up all your dollar assets and you have to put them in another global currency. Pick one. What are you going to pick? The yen?
Right.
The euro? Like, no.
The yen,
no.
just because it's in the headlines and they're having issues devaluing it right now. That was a hot.
Yeah,
hot
there's
topic.
nowhere to go. And I'm not saying we have our house in order. We got a bunch of clowns in DC, clowns. But like, we really are the best house in a bad neighborhood by far.
Yeah.
Okay. So, okay, let's talk about value and growth for a minute. So a question about, hey, and if you're not aware, if you're listening and not aware of what's happening here, for 5 to 10 years, stocks that have had high earnings growth, but not necessarily like dividend. I mean, they do, some of them pay dividends, but stocks that are a little more boring, a little more steady, priced more fairly, those are called value, and they tend to be correlated with high dividend paying stocks.
You might think like Qualcomm, McDonald's, Verizon, AT&T, some of these big companies that you're like, they're huge. They just struggle to get a lot bigger than where they're at.
And they're steady and they pay dividends, and a lot of retirees tend to like them. And then high growth stocks, a lot of the tech stocks and some healthcare and others have been just high flying. And the growth side of the market has just been the darling for 5 and 10 years. And it's been amazing. And then recently that just flipped on its head for a period of months to almost a year. So Kurt, talk to us about that change. And the question is, hey, value seems to be making a run. Do you think this is transitory, or do you think value has more room to run, and is it here to stay?
It's such an awesome question. Zach, you and I alone together have had spent how many hours talking about this?
Many.
To me, it comes down to two things. What it's not is a reversion to the mean trade. It's not. There are structural issues here that make growth and value different. So let's go back several years, okay? Remember what was the old growth in the US economy? Do you remember when Lowe's and Home Depot and Walmart were the growth drivers 30 years ago, right? Remember moving from strip malls and mom and pops into big box? You guys were kids, probably. I'm a lot older than you. That was the growth driver in the US economy, right? So what happened was, in the old days, go back to the railroads, the businesses that were driving GDP growth in the United States were value-y type companies, stodgy, equipment heavy, capital intensive, right? Okay, there's a very structural difference to what's going on. Tech and biotech in the 80s and 90s were highly speculative businesses, and they were not the drivers of the US economy. They were fringe players, okay? We are in a whole new world, and we saw it in COVID. Safe today is technology. No one wants to admit this. Safe is tech, because the old line boring businesses are not growing. There was a time, you guys, that Home Depot, Walmart, and Lowe's were growing at 30% a year in this country. That is the most boring business on the planet now. It's like grocery. So they have these big balance sheets that are bloated with debt, and there's no growth. I don't care what dividend you pay me, there's no growth. So like, that is not driving our gross domestic product. Let me give you another example. Do you guys remember when energy was our growth driver? We went through a 15-year period in the United States where we started tapping our ground and pulling oil out of the ground. You guys remember this? We wanted to get off dependency from the Saudis. We were pulling energy out of the ground like no tomorrow. There was a point where the S&P 500 was 18% energy.
Holy cow.
Because the gross domestic product of the United States was being driven 1/5 by energy. Today, 2.5% of the S&P 500 is energy because it's not what the growth driver is. I hate to say it, but it's Google and Microsoft and Facebook and Amazon, all these guys that we all have grown to hate, kind of a love-hate relationship with. This is where all the GDP is growing from. And get this, on top of that, they do it with no debt. No debt.
And amazing cash flow. And their cash flow is
amazing cash flow.
Yes.
And what's the capital expenditures? There's no CapEx. They
Right.
don't build plants and 50,000 square foot. I mean, warehouses. Yeah, Amazon builds warehouses, but this is not the front end, right? And then the final thing, and I want to show this to you, and this is one of my worries. This is going to answer 2 of your questions with one stone. This is one of my number 1 worries, okay? In value, one of the biggest problems in value right now, by the way, this is not saying no value. I love value. There's a lot of great parts of value. One of my favorite parts of the capital markets right now is energy. I know this is not a recommendation to buy or sell. I shouldn't say that like on a call like this. I love energy right now.
Don't worry, it's recorded. It's fine.
Okay, I know. And I'm sure I'll get a call by the end of the afternoon from somebody, but I love energy right here. But one of the things that is really different now is these zombie companies. And a lot of these companies are in the value part of the stock market. And all the zombie means is a fancy word for these are companies that just the cost of their debt is more than their profits. Just the cost to service their debt, their interest costs are more than their profits. In the 90s, it was nothing. It's almost 20% of the publicly traded companies now are in that boat. Most of these are value companies. Most of them are value stocks. They are bloated balance sheets, carrying around way too much debt, and they don't have a lot of growth. And that's why you're seeing value struggle against growth. Is it warranted? I'm actually starting to think there are some cheap banks and some cheap energy companies. But nevertheless, gross domestic product, Zach, is being driven not by these companies. So,
and Kurt, I'll add on there just to kind of add some color. If you want to say, could value make a run? The argument would be in favor if inflation hits and it goes higher or shows up more than we anticipate. Value would play better because those companies are more asset labored. So they've got more assets and hard assets, real assets that appreciate with inflation. And it gets harder for competition to come in on those companies, which means they typically can widen margins.
Right.
So that's kind of the case for value in that. And I think that's why you might hear people saying, well, it could be coming. It's because it is in correlation with saying, well, if inflation comes, you could make a strong argument that value stocks would flip.
And year to date, the value stocks have outperformed the growth stocks here year to date. Now, at one point, they were outperforming by a lot more. But in the last couple of months, the growth stocks are sort of catching back up.
Oh, hey, in terms of looking at businesses, and I mean, one question we have is about earnings for Q2. So basically, we've had earnings estimates. So for those of you guys listening here, basically these companies say, we think our earnings are going to be this. So then the market decides, of course, to price that into the stock. And then if the earnings come in a little above, the market will oftentimes go up a little bit. And if they come in a little below, they'll go down, which is kind of ridiculous sometimes, right? That it's like, oh, their earnings went up by 10%, but the stock is down because they told us they were going to go up 11%.
Right,
Anyway, that's the game that we play every quarter around earnings announcements. So the question is, do you think that Q2 results will be enough to satisfy analyst forecasts that were revised upwards?
I do. It's really interesting. We're in this spot where the companies are really doing a lot better than people think. I mean, let me show you one slide here. Let me share my screen again. What's happened is, and by the way, I say this actually as both a bullish point, but actually kind of sad, is that in the United States, the big companies, they cleaned up during COVID at the expense of the mom and pops. I mean, and the stock market is full of the mega players, right? People don't realize that our big corporations are actually making a lot more money than they were at the peak in 2018 and going into COVID, like a lot more money. We had a major wealth transfer of profits in this country. from mom and pops and small businesses to big players. You know, remember in April of last year when you couldn't go to the mom and pop hardware store, but you could stand in line and get into Home Depot, it might be Monday morning quarterbacking, but the government basically said, screw the little guy and the big guys are going to win. And that's how this went down. And that's what's in the S&P 500. And so the profits that are being generated are pretty massive. And the only thing that's really a headwind is sort of these commodity costs and these wage costs. And that is going to start playing in more. But right now, people are still panicking to buy stuff coming out of the recession,
So I'm getting like, we're not going to get away from inflation, Kurt. I mean, I have 3 more questions here. So we're coming back to government spending and inflation. Clearly you can see this is the one question that we get a lot of over and over again. So we really have three current questions that I'm going to try to wrap them up into one almost and have you kind of tackle them as you see fit. So one of them to for sure hit is, I feel like we've been pretty positive or bullish about the current spending situation by our government. And I think this is a really valid question, which is there no negative consequence from government federal spending? And there is, but let's go over that.
Yeah, no, and the truth of the matter is, the 2 biggest concerns I have, I actually, and by the way, I have a big investment committee here, right? I mean, we manage billions of dollars at this firm. I got a 9-man investment committee that sits in this room next to me every Tuesday afternoon and argues this out. And I got people not concerned about inflation. I am. Inflation is my number 1 worry as well, Zach. Right next to that is these zombie companies. There are people borrowing money. Be careful the bonds that you own. Be careful the bond funds that you're in. There's a lot of debt in the system that's gonna file for bankruptcy at some point. That's the nature of the beast. So I don't mind that question because I'm worried too. And here's what the negative consequence is. It goes back to something we talked about earlier. When the velocity of money goes up, it hasn't been. People are holding it in the bank. I think asset prices go higher, and then people get cocky. They don't learn from the past, and then they start getting reckless. They're going to buy that. It's not happening yet, but they're going to get reckless at some point with their money, 2, 3, 4 years out. Take speculative risks they shouldn't be taking. Then we're going to start having some trouble. And here's what it's going to come down to, Zach. Can the Federal Reserve and these morons in Washington, can they reel in what they're sending out right now? I think the moves have been right. I think easy monetary policy has been good. It's been right. It's worked. But nobody ever wants to take the punch bowl away. And not even, and I'm not picking sides. I can't stand any of them. But not even the Republicans who used to not want to spend money, they want to spend. Now we're in an arms race to see which party can spend more money. That's where we're at right now, right? So will they reel in some of what they created? And this is the moral hazard to the questions you're getting here. And if they can't, we're going to have 3%, 4%, 5% inflation. And we have a lot of problems, right? Our economy is not going to, we could go through 10 years of no growth. We could come out of this explosive period of growth that might last another year, 2, 3. And then we could go through a decade of no growth and become Japan.
Right. Okay.
And that's the risk.
Okay. So with our time left, really there's 2 questions that kind of are one, which is, hey, should a retiree own bonds? Why? I mean, this is partly Matt and my job, but it'd be good to get your flavor on this. Basically, is there a place for bonds in a diversified portfolio for a retiree? And how does all this talk about inflation affect the fixed income in our clients' portfolios who are really mostly into or close to in retirement?
Yeah. Remember a couple things. Number one, not all inflation is bad. Inflation is almost always indicative of a good economy. And in fact, and I have a slide in here. In fact, I'm not even going to show it because I'll just tell you the punchline. Since 1950, every single time we start raising interest rates in this country, the stock market has some of its very best years the next 2 years. So everybody seems to think, oh, as soon as rates start rising, it's going to be problematic. It's actually not, because it's usually indicative of a really thriving and healthy economy. So as rates start to go up, yeah, your bond prices temporarily go down, but you're going to start making more coupons on your bonds because rates are going to start going back up. You're going to start getting more yield from your bonds again. So the first part of the question, oh, go ahead.
I was just going to say on the bond part. So the way we look at it as a financial advisor is that you're not buying one bond, nor are you buying a bunch of bonds all at the same maturity. So when you have a diversified bond portfolio, yes, the average rate right now isn't that exciting. However, you do have bonds maturing, even if it's within funds. You have bonds maturing at the near end. So as we go through the next 2 or 3 years, if rates go up slowly, you're getting bonds that are maturing that you're able to buy at higher rates. So the idea is, yes, you're really not going to make a ton of money on bonds. You also are not likely to experience a lot of inflation. I'm sorry, a lot of volatility if you have conservative bonds. So what
Yep.
you're doing here is you're just being patient. You're being patient, putting up with a little bit less return than what you might get in stocks because it's less volatile and less risk. But anyway, you're being patient, and then one of two things is going to happen. Either a stock market decline happens and you can take some of your bonds and take advantage of that, or
Right.
two, a stock market decline doesn't happen. Rates go up and a bunch of your bonds mature and you keep buying at better rates. And the average yield of your bond portfolio goes up to a level that you're no longer feeling like you just have to be patient. You're actually appreciating a 4 or a 5% rate of return on your bonds. So you don't want to avoid bonds entirely just because you think that the stock market has a better run. You'll take on unnecessary risk. So this is where personal financial planning really comes into play. But that's how we see bonds in the portfolio. You're just being patient and you're being prudent.
I could not agree with what you said more. And by the way, think about this. Let's say right now your portfolio is 1/3 bonds and 2/3 stocks, just to use a common allocation. Okay. Okay. We're all a little nervous right now because stocks went up more than we all thought they would. And since '08, they've gone up way more than we all thought they would. Everybody thought the world was ending then. Everybody thinks the world's insane now. Okay. So what we counsel people to do is just acknowledge the fact that some of your growth stocks are expensive right now, but don't sell them. Because if you're wrong and they go up another 100%, great, you're invested. But you've got the third of your portfolio in something, yes, true, not making you a lot of money at the moment, but very safe, very liquid, and it gives you optionality going forward. I remember when I was a really young kid and I went to the New York Stock Exchange as a trader. Right when I got down there, I had a big trade on. I wasn't sure about it. I'm a punk kid. And my mentor on the floor says, well, when in doubt, sell half and hope you're wrong. And I never forgot that. And really what we want to do is have a blended portfolio and hope we're kind of wrong. I kind of hope that stocks keep going up and I don't make a lot of money on my bonds. That's great. I still will have made a lot of money. But if the market does have a big correction, I can rebalance my portfolio at the very best time to do buying. So even with low interest bonds, I want to own some. That's the bottom line. I need some high quality liquid assets in my portfolio. But hey, if the madness keeps going and everything keeps still going up, I'm still making a lot of money, you know.
And real quick, I'm going to jump in just because we have given a lot of positives in this overall for the case for the markets. And I think most people end up maybe not giving that. But I will just say one of the negatives that we see is just with the amount of evaluations we have. I always use the meteorologist standpoint, right? Meteorologists are the only ones that can predict the weather every day and get it wrong and still go in on Monday and have a job. So it's similar to that from a standpoint of forecasts are the same way. The one thing I will say is with the evaluations being high like they are, it's not to say that we're going to hit a crash. But what it would say, it's like the meteorologist saying, hey, it's going to be snowy tomorrow. It's going to be rough on I-15. Doesn't mean if you go on your road trip and you hit I-15, you're going to get in a wreck. But what it does mean is the road is probably more conducive for the possibility for a wreck or volatility to interject and be more than we thought it would be.
Drive slower.
Drive slower.
Own some bonds.
And that's what it is. So I feel like when people are coming to me, you don't want to just have just stocks. You want this diversified portfolio that you're talking about, because when people are saying hit the gas, you want to say, well, wait, we should probably hit the brakes, or we should probably lay off the gas. And so I think for me, just saying that, just understand the environment with the high valuations is that the market can be volatile if this infrastructure plan doesn't go through, or if one thing doesn't occur that the stock market likes, doesn't happen, we can experience volatility we weren't anticipating. And that wouldn't be a cause for us to panic overall because of all the cases we've laid out for being positive with the market. But it does mean it could be very high likely that it happens over the next 6 months.
All right, we're at time. Kurt, You're amazing. We appreciate it. Matt, thanks for joining. This has been really, really nice. If you have questions and you want to talk about this further, reach out to your advisor. We'd be happy to talk through it and really see how it applies to your specific situation. Some of this stuff really needs to be applied to your situation. But Kurt, we love having you on. You do such a great job.
Hey, I love being with you guys. I've learned over the last several years too, you have great clients. They have great questions on these calls. I love it. It's why I like coming back.
The opinions expressed in this program are for general informational purposes only and should not be considered as advice or a recommendation. Opinions expressed by guests do not necessarily reflect the opinion of Capita Financial Network. Past performance discussed is no guarantee of future results. Capita Financial Network does not provide tax or legal advice. If you have further questions, please contact your financial advisor.